Disclaimer. December 19th, 1995. The policy room of the Bank of Japan. ***, a single decision, intended to be a temporary relief, would lock a nation into a quarter-century economic experiment. 0% interest rates. A desperate cure for a banking crisis and a deflationary spiral. It would become a permanent trap. By 2016, the rate would plunge to negative 0.1%. The cost? Over 25 years of economic stagnation. A $9 trillion stock market collapse from its peak, taking 21 years just to recover its 1989 high. A lost generation of growth, sacrificed on the altar of cheap money. This is the story of the liquidity trap, a terminal economic condition where monetary policy breaks, savings are punished, and an economy enters a slow, silent collapse. This pattern has neutralized every central bank that has ever triggered it. It is a playbook of economic suicide, written in the ink of zero and negative interest rates. We call it the 5 stages of monetary collapse, a framework proven by history, now playing out on a global scale. It is a one-way journey from temporary stimulus to permanent dysfunction. Stage 1. The emergency cut. A panicked response to crisis. Rates are slashed to zero. Stage 2. The addiction. The temporary zero rate becomes permanent, distorting all asset prices. Stage 3. The negative plunge. Desperation sets in. Rates go negative, shattering the banking model. Stage 4. The zombie apocalypse. Unproductive companies are kept alive by free money, killing productivity. Stage 5. Currency crisis and loss of sovereignty. The final act. The currency destabilizes and the central bank loses control. This pattern took Japan 25 years to play out in full. It is a blueprint, a warning, a countdown. And the United States, the European Union, and much of the developed world are now at stage 3. #Economy Rewind. Japan's negative rate trap. Historical context: the rise and the fatal decision ***. The rise. They called it the Japanese miracle, a phoenix rising from the ashes of World War II. From 1950 to 1970, Japan's economy grew at an average rate of over 9% per year, a vertical climb unseen in modern history. By 1968, it had overtaken West Germany to become the world's second-largest economy. Its manufacturing, particularly in electronics and automobiles, became synonymous with quality and efficiency. The Nikkei 225 stock index was a rocket ship. From 3,000 in 1975 to a peak of 38,915 on December 29, 1989. In 14 years, a 200% increase. Tokyo's Imperial Palace grounds were, at their peak, theoretically worth more than the entire state of California. The land beneath Japan was valued at 4 times the value of all land in the United States. Corporate Japan was invincible. Banks were the largest in the world by market capitalization. The Ministry of Finance and the Bank of Japan were viewed as economic masterminds, guiding a planned capitalism that could not fail. By 1989, Japan accounted for over 40% of the total value of all global equity markets. The narrative was unshakable. A new economic superpower had arrived. The 21st century would be the Japanese century. They had cracked the code. They were not just winning the game. They were rewriting its rules. Confidence was absolute. The fatal decision. The trigger was not a single day, but a deliberate policy choice. The bubble, fueled by reckless bank lending and speculation, began to deflate in early 1990. The Nikkei started its long, brutal slide. By August 1992, it had crashed 63% from its peak. Bad loans choked the banking system. A financial crisis was brewing. The Bank of Japan, led by Governor Yasushi Mino, was faced with a critical choice. The orthodox economic playbook demanded they let the bubble's excesses purge from the system, allow bankruptcies, force restructuring, accept short-term, sharp pain for long-term health, the creative destruction described by economist Joseph Schumpeter. They chose the opposite path. On July 1, 1991, the Bank of Japan began cutting its discount rate. This was the initial, cautious step. But the crisis deepened. The banking sector, holding trillions of yen in bad debt tied to collapsed real estate, teetered on the edge. Then came the pivotal, fatal turn. On December 19, 1995, the Bank of Japan cut its overnight call rate to 0.5%. Then, on February 12, 1999, they took the unprecedented step for a major economy. They cut the overnight rate to 0%. The stated goal was temporary, to provide time liquidity to the banking sector, to help banks earn their way out of the bad debt crisis by borrowing for free, to stave off deflation, a general fall in prices that increases the real burden of debt. It was a lifeline, a short-term bridge to recovery. But the bridge never ended. Senior officials believed they could manage the process, that they could stimulate just enough and then normalize. They ignored a fundamental truth. Zero interest rates are a narcotic, not a medicine. They create dependency. They destroy the pricing mechanism of capital. They send one unequivocal signal to the entire economy. The emergency is permanent. The warnings existed. Some economists pointed to the liquidity trap theories of John Maynard Keynes. They warned that at near-zero rates, monetary policy becomes like pushing on a string. It loses all traction. Money is hoarded, not invested. Nobody in power listened. The consensus was to do more of the same, to double down. The temporary emergency measure became a permanent feature of the landscape. The Bank of Japan had unknowingly lit the fuse on a 25-year economic experiment, an experiment that would provide the modern blueprint for how a central bank can methodically destroy its own economy. The trap was set. The pattern breakdown, the 5 stages of monetary collapse. History does not repeat, but it rhymes. The Japanese experiment was not an anomaly. It was the clearest, most data-rich modern example of an ancient pattern, the destruction of an economy through the slow poisoning of its price of money. We see this pattern in the decline of empires, the collapse of currencies, and the paralysis of financial systems. It follows a predictable 5-stage path. Stage 1, the emergency cut. The initial, panicked response to a crisis. Interest rates are slashed to zero, sold as a temporary, necessary shock treatment to stabilize the system. Historical precedent 1. The Roman Empire, 3rd century AD. Event, the crisis of the 3rd century. Facing barbarian invasions, civil wars, and plague, Emperor Aurelian and his successors began a massive debasement of the silver denarius. Data, silver content in the denarius fell from over 90% pure under Nero, 54 to 68 AD, to less than 5% by 268 AD. This was the ancient equivalent of a zero-rate policy, destroying the value of savings and capital to fund immediate state emergencies. Duration, the severe debasement phase lasted over 50 years. The decision, short-term military survival, was prioritized over long-term monetary stability. The result was hyperinflation, a collapse in trade, and the near dissolution of the empire. Historical precedent 2, the Weimar Republic, 1921 to 1923. Event, the Reichsbank, under pressure to finance war reparations and social unrest, began monetizing debt by printing money and keeping discount rates artificially low. Data, the discount rate was held at 5% in early 1921, while inflation raged at over 300% annually. This was a massively negative real interest rate policy, the functional sibling of a zero-rate policy, destroying capital. Duration, the hyperinflationary spiral took just over 2 years to complete the destruction of the mark. The decision, political expediency, avoiding domestic unrest and defying the Allies, overrode sound monetary policy. The central bank became a tool of the state treasury. Historical precedent 3, the United States, 2008. Event, the Federal Reserve, facing the collapse of Lehman Brothers, slashed the federal funds rate from 5.25% in September 2007 to 0.25% by December 16, 2008. Data, this was the fastest, deepest rate cut in Fed history. The stated goal, provide emergency liquidity to prevent a total financial meltdown. Duration, 7 years. The Fed would not raise rates from zero until December 2015. The decision, the Greenspan/Bernanke put, was executed in full. Moral hazard was ignored. The system was saved, but the addiction to free money was cemented globally. The line between emergency and permanence was crossed. Stage 2, the addiction. The temporary zero rate becomes permanent. The economy cannot function without the stimulus. All asset prices, real estate, stocks, bonds, become distorted, creating phantom wealth tied solely to the cost of borrowing nothing. Historical precedent 1, Japan, 1999 to 2016. Data. After first hitting 0% in 1999, the Bank of Japan's policy rate remained at or below 0.5% for 17 of the next 22 years. The economy flatlined. Nominal GDP in 2020 was roughly the same as in 1995. Distortion. The entire Japanese government bond, JGB, market was paralyzed. Over 90% of JGBs yielded less than 1% for a decade. Price discovery was dead. Historical precedent 2, the United States, 2009 to 2015, and Europe, 2012 present. Data. The Fed held at zero for 7 years. The European Central Bank, ECB, hit 0% in 2012 and never truly left. This created a global hunt for yield, inflating asset bubbles worldwide. Distortion, the everything bubble. From Silicon Valley unicorns to Picasso paintings, all assets repriced based on near-zero discount rates. Economic growth, however, remained anemic. U.S. productivity growth averaged just 1.1% from 2010 to 2019, half the post-World War II average. The pattern is clear. Stage 1 is the diagnosis of a critical illness. Stage 2 is the administration of a permanent opioid drip. The patient is kept quiet, but the disease festers. The system becomes incapable of functioning without the drug. And as tolerance builds, the dosage must be increased. This leads to the point of no return. #economy rewind. Japan's negative rate trap. Stage 3, the negative plunge. Desperation becomes policy. With zero rates providing no growth, central banks cross the final psychological and financial Rubicon. They make money officially. Permanently costs something to hold. They take rates negative. Historical precedent 1, Japan, 2016. Event * on January 29, 2016, the Bank of Japan announced a -0.1% rate on certain bank reserves. Data * this was the culmination of a failed 17-year experiment with zero. Core inflation had averaged 0.2% from 2000-2015. The policy was a direct charge on bank profitability. Consequence * the banking sector's net interest margin, its profit engine, was systematically dismantled. The Topix Banks Index fell 50% over the next 4 years while the broader market rose. Historical precedent 2, the European Central Bank, 2014 to 2023. Event * the ECB introduced a negative deposit facility rate of -0.1% in June 2014. It would go as low as -0.5% and stay negative for over 8 years. Data * this created a Euro 4 trillion pool of negatively yielding European bonds at its peak. Banks were penalized for holding reserves, forcing them into riskier assets or to simply eat the cost. Consequence * the European banking system became a permanent zombie. Unable to generate organic profit, it survived on periodic central bank liquidity injections, TLTROs. It could not lend, nor could it fail. The mechanism of destruction * negative rates are attacks on the financial system's core function, intermediation. They tell the world that capital is not just free, but a liability. This inverts reality. It shatters the business model of pensions, insurance companies, and savings institutions. The search for yield becomes a desperate, system-wide gamble. Stage 4, the zombie apocalypse. The most corrosive stage. Free money doesn't just distort asset prices. It distorts the very process of creative destruction. Unproductive, Insolvent companies are kept alive by perpetually refinanced debt at near zero cost. They become zombies. Historical precedent 1. Japan, 2000 present. Data *, the Bank of Japan's own research shows the proportion of zombie firms, companies unable to cover debt servicing costs from profits for 3 consecutive years, more than doubled from the 1990s to the 2010s. Impact *, these zombies clog economic arteries. They suppress wages, stifle innovation, and compete with healthy firms for labor and resources, dragging down overall productivity. Japan's labor productivity growth averaged a pathetic 1.1% from 2000-2019, the lowest in the G7. Historical precedent 2. The Eurozone, 2015 present. Data *, a 2023 ECB study found the share of zombie firms in the Eurozone had risen to 10% of listed non-financial firms, double the pre-2008 crisis level. Impact *, these firms account for a disproportionate amount of debt and employment, creating political paralysis. Letting them fail would cause massive job losses. Keeping them alive strangles the future. The system chooses the slow death. Historical precedent 3. The global context, 2020 present. Event *, the COVID-19 pandemic response saw a global explosion in corporate debt, much of it at rock-bottom rates to companies with poor fundamentals. Data *, the Institute of International Finance estimated global corporate debt hit a record $86 trillion in 2021, up from $75 trillion in 2019. A significant portion of this refinanced potential zombies. Impact *, this has created a zombie drag on global productivity. Capital is misallocated on a historic scale, trapped in dying industries instead of funding new innovation. Stage 5. Currency crisis and loss of sovereignty. The final act. After years or decades of distortion, the currency itself becomes unstable. The central bank loses all credibility and control. It faces an impossible trilemma: defend the currency, raise rates and crash the zombie-laden economy, impose capital controls, admitting failure, or watch the currency devalue in a disorderly collapse. Historical precedent 1. The Roman Empire, late 3rd century onward. Event. After decades of debasement, Stage 1. The currency became worthless for large-scale trade. The economy barterized and regionalized. Loss of sovereignty. The Emperor Diocletian was forced to issue the Edict on Maximum Prices, 301 AD, a desperate attempt at wage and price controls, the ultimate admission that monetary policy had failed. Economic sovereignty ceded to draconian state command. Historical precedent 2. The Weimar Republic, 1923. Event. The hyperinflation triggered by persistent negative real rates, Stage 1 of 2, culminated in November 1923. Data. The Reichsbank was printing 500 trillion mark notes. The currency lost all function. Loss of sovereignty. Germany had to scrap its currency entirely and introduce the Rentenmark, backstopped by mortgage bonds on land and industry, a collateralized currency of last resort. The central bank was neutered. Historical precedent 3. Japan, 2012 present. The quiet crisis. Event. The yen's value has become a volatile, unstable byproduct of BOJ policy, not a reflection of economic strength. Data. In 2022, the yen crashed to a 32-year low against the dollar, plunging over 30% in 1 year as the BOJ clung to negative rates while the Fed hiked. Imported inflation smashed Japanese consumers. Loss of sovereignty. The BOJ was forced into massive, unlimited bond buying to defend its yield curve control policy, effectively monetizing nearly all government debt. It now owns over 50% of all Japanese government bonds. The market now dictates to the central bank, not the other way around. Monetary policy independence is gone. The pattern is complete. Emergency. Addiction. Negative plunge. Zombification. Collapse of control. Japan has given us the modern, slow-motion playbook for all 5 stages. A 25-year real-time case study. And this is not just a Japanese story anymore. and the United States and the Eurozone are at stage 3. Right now, the emergency cut of 2008 to 2020 was stage 1. The addiction to zero and quantitative easing lasted over a decade, stage 2. In 2022, facing historic inflation, the Federal Reserve and the ECB were forced to attempt normalization. But the system, after 15 years of addiction, revolted. The collapse of Silicon Valley Bank in March 2023 was not a random event. It was the first tremor of stage 3, the negative plunge in real terms. Because while nominal rates have risen, the financial system is still drowning in assets priced for a zero-rate world, and the real cost of money remains broken. Current evidence. The hidden negative rate. With U.S. inflation running at a 3.5% annualized core rate and the Fed funds target at 5.25 to 5.50%, the nominal real rate is slightly positive. But this ignores duration risk. The U.S. Treasury market, the bedrock of global finance, is still pricing in a return to the zero era. The 10-year yield, while elevated, consistently trades below the rate of inflation expectations over its lifetime. The market believes the zero-rate regime will be back. This is a forward-looking negative real rate expectation, the same psychological trap. The bank stress. The March 2023 banking crisis saw the second and third largest bank failures in U.S. history, SVB, Signature. The cause? These banks were stuffed with long-dated treasury and agency bonds purchased when rates were near zero. When rates rose, the market value of those safe assets collapsed. The entire banking system is sitting on over $600 billion in unrealized losses on securities, according to FDIC data. The system is functionally insolvent if forced to mark assets to market. This is the direct, mechanical result of the addiction stage. The central bank balance sheet bloat. Despite quantitative tightening, the Fed's balance sheet remains at $7.4 trillion as of April 2024, down from a peak of $9 trillion, but still over 8x its pre-2008 size. The ECB sits at 7 trillion euros. This is not a normalizing system. It is a system permanently dependent on central bank life support. The bank reserves created by these assets are the new base money, and their sheer volume distorts everything. The policy capitulation. At the first sign of system stress, the 2023 bank runs, regulators invoked systemic risk exceptions, bailed out all uninsured depositors, and launched the Bank Term Funding Program, BTFP. This allowed banks to borrow against their devalued bonds at par value, not market value. This is a direct, undisguised subsidy to keep the zombified system alive. It is staged for conduct during stage 3 stress. The catalyst, March 10, 2023, 11:15 a.m. Eastern Standard Time. Silicon Valley Bank was placed into FDIC receivership. Its collapse was not due to risky loans, but to the most conservative asset on earth, U.S. Treasury bonds. The entire world watched as the mechanical consequence of rapid rate hikes on a zero-rate addicted system played out in 48 hours. Every Treasury department, every central banker, every institutional investor realized the same terrifying revelation. The global financial system cannot tolerate normal interest rates. The patient is too weak. The addiction too deep. The response was not a purge of the weak. It was a doubling down on the distortion. The BTFP, the swift takeover of Credit Suisse. The implicit guarantee extended. The message was clear. There will be no creative destruction. The zombies will be protected at all costs. We are now actively managing stage 4. Stage 3 and 4 indicators, right now. Banking system unrealized losses, $517 billion. FDIC Q4 2023. This is not ephemeral. It is capital that cannot be lent. Commercial real estate meltdown. Office property values down 35% from peak. Green Street, April 2024. This is the next wave of zombie creation, as $2.2 trillion in loans need refinancing before 2028. Corporate debt servicing. While rates are high, Corporate interest expenses are near historic lows as a percentage of revenue, St. Louis Fed. Why? Because most debt was locked in at near zero rates for years. This is the artificial life support of stage 4. When this debt rolls over, the zombie cull begins. Central bank losses. The Fed is currently running an operating loss of over $100 billion annually, sending no remittances to the Treasury for the first time in modern history. It is technically insolvent on a mark-to-market basis. This is a central bank losing its financial and political capital. The Japanification yield curve. The U.S. 10-year yield remains stubbornly below 4.5% despite high policy rates and inflation, mimicking Japan's controlled, flattened curve. The market does not believe in a long-term return to normal. We are here. The Western financial system is in the middle of the same playbook Japan wrote. We have taken the negative plunge into real financial instability. We are conducting the zombie apocalypse in real time. The only remaining question is how stage 5, currency crisis and loss of sovereignty, manifests for the dollar and the euro. Consequences and timeline. What this means. The 5 stages are not a theory. They are an autopsy report written in advance. If you are embedded in the current system, reliant on its wages, its pensions, its currency, the consequences are not abstract. They are a redistribution of wealth and stability on a generational scale. For the winners, the state and its apparatus. In a zombified economy, the state becomes the ultimate arbiter of capital. It decides which companies live via bailouts, grants, contracts, and which die. This translates to increased political control over the economic sphere. Bureaucracies and agencies that manage stimulus, subsidies, and national champion industries will expand in power and funding. Assets, not currency, holders, those who shifted wealth out of cash and sovereign bonds and into tangible, productive, and scarce assets before the great distortion will win. This includes productive farmland, critical mineral resources, energy infrastructure, and equity in non-zombie, cash flow positive businesses with pricing power. Gold's 15-year bull market from 2008 to 2023, outpacing most major asset classes, was the first warning shot. The financial arbitrageurs, large, systemically important institutions that can access the Federal Reserve's lending facilities, like the BTFP, at privileged rates. They are not playing a market game. They are playing a political access game. The too big to fail designation becomes the most valuable asset in the world. Jurisdictions with sound money. Countries that avoid the negative rate trap or that have hard commodity-backed currencies will become capital havens. This already manifests in the relentless de-dollarization moves by BRICS nations and the shift of gold reserves from the West to the East. For the losers, the middle-class saver, the person who followed the old rules, save cash, buy government bonds, plan for a pension. They are being systematically impoverished through financial repression. Their savings yield less than inflation. Their pension funds, trapped in low-yielding bonds, become underfunded and risk insolvency. The productive small and medium enterprise, SME zombie corporations, kept alive by cheap debt, undercut them on price, steal market share, and clog supply chains. Access to capital dries up as banks, burdened by losses and regulation, lend only to the safest, often largest, or state-connected entities. This is the death of Schumpeterian entrepreneurship. The traditional banking model, it is already dead. Net interest margin compression is permanent. Banks become utility-like conduits for central bank policy, not profit-driven intermediaries. Their stock is dead money. Japan's bank stocks have been a 25-year value trap. Social and political stability. The endgame of zombie economics is stagnant real wages, rising wealth inequality, and generational disillusionment. This fuels political extremism, erosion of social trust, and the rise of populist movements blaming immigrants, other countries, or elites for a crisis that is, at its core, a monetary phenomenon. Projected timeline. Based on the Japanese precedent, 25-year full cycle, and the accelerated, globalized nature of the current crisis, we can project a compressed timeline. 2024 to 2030. The management of Stage 4, peak zombie. Inflation will remain structurally higher than the pre-2019 era, but central banks will be unable to sustain hawkish policy due to systemic financial fragility. We will see a series of rolling, contained financial crises, commercial real estate, private equity, leveraged loans, met with new, creative bailout facilities. The formal or implicit adoption of yield curve control, YCC, in the US and EU, following Japan's model, to cap government borrowing costs and prevent a bond market collapse. Acceleration of central bank digital currency, CBDC, development as a tool for targeted stimulus and greater transactional control in a failing system. 2030 to 2035, the fracture and Stage 5 onset. The geometric growth of debt and the exhaustion of policy tricks will force a crisis of legitimacy and a break in the global monetary order. A major, involuntary devaluation of a core currency, likely the euro or Japanese yen, as capital flight overwhelms intervention capacity. The end of the US dollar's unquestioned exorbitant privilege. It will remain a top currency, but will share the stage with currency blocks, digital yuan, gold trade settlement systems. Widespread sovereign debt restructurings under the guise of modern monetary theory or debt jubilees, functionally erasing savings held in those bonds. 2035 to 2050, the new system. The post-collapse landscape will be defined by what replaces the broken framework. Bimetallism or commodity-backed digital currencies. A return to some form of outside money not solely based on central bank fiat. Gold and possibly energy-based digital tokens will form the backbone of a new, less elastic international settlement system. Regional economic blocks. Globalization fractures into competing spheres of monetary and trade influence. Americas/dollar, Europe/euro, Asia/yuan +/. The end of central bank independence. A historical blip lasting from the 1980s to the 2020s. Monetary policy will be formally reunited with fiscal policy under direct political control. The bottom line. The pattern is clear. The path from emergency rate cuts to currency crisis is a one-way street paved with good intentions and terrible incentives. Japan proved it could take 25 years. For the globally interconnected, debt-saturated West, the timeline is shorter. The velocity of money, of crisis, is higher. The question is not if the current monetary system collapses under the weight of its own distortions. The Japanese experiment answered that. The system, as designed, is already broken. The only question is when the final stage triggers. Based on the acceleration of the cycle, the timeline for a terminal currency crisis and loss of monetary sovereignty is 10 to 15 years. By 2040, the world's monetary map will be unrecognizable. The collapse is not an event. It is a process, and we are already halfway through it. Disclaimer: this video is for educational and informational purposes only. It presents historical analysis, opinions, and interpretations based on publicly available sources. It is not financial advice, political advice, or a prediction of future events. All historical comparisons and references to modern countries or governments are theoretical and should not be interpreted as claims, certainties, or endorsements. Viewers are encouraged to research independently and draw their own conclusions. December 29, 1989. The peak. The moment of supreme confidence. From that day forward, every intervention by the Bank of Japan was a step deeper into the trap. The emergency cut, the addiction, the negative plunge, the zombie economy, the loss of control. They were not evil. They were not stupid. They were following the playbook of their time, fighting the last war. And in doing so, they wrote a new one. A playbook now open on every major central bank's desk. The pattern does not care about your politics. It does not care about your nationality. It is a mechanism. Input zero. Output collapse. Japan tried negative rates for 25 years. It didn't save their economy. It defined its permanent stagnation. And we are following them, step for step, into the same quiet room. For Economy Rewind, I'm your narrator.